Does this matter to the market?
It'll matter very short term, Michelle. I'm kind of with Tim, I think, and Karen. I think what you have to do is look at what really drives the market over time. President Clinton was impeached at the end of 1998. That wasn't the peak of the tape. President Nixon was impeached in 1970, or wasn't impeached, but resigned in 1974. That was the low of the tape. So it depends on what credit.
Tony, it actually wasn't the low. So, I mean, if you look,
well, yeah,
the S&P 500
year,
in January of 1973 traded at an all-time high of 120. Okay?
Who cares about it? Hold on, can I ask a basic question? Hold on.
It kept going down. Like I said, it was going
50% peak.
Hold on one second. People are going to tune in right now. They're going to see that intraday chart. They're going to know that all this news started to break late in the day. What do you draw from that chart? The chart sold off because of what was happening this afternoon? Or do you say, it's off by 1/3%? It's shrugging off what happened today.
Points. Yeah, both are true. It did sell off because of that, but that's a pretty modest sell-off. Very modest, actually. I think that probably a lot of people thinking, you know what, if the market really gaps down a lot, I'd love to step in and buy. I think there's a lot of money still.
Credit is in really good shape. I mean, ultimately, the market moves with credit, with direction of earnings, which is driven by economic activity, which is driven by the availability of credit. So last Friday, I'm on the phone with a bunch of clients, and I asked them two very simple questions. Everybody's worried about liquidity, you know, a shutting down of liquidity to spend. I asked every portfolio manager I've talked to, are you hearing from your companies that business is slowing dramatically? And the answer was universally no. Are you hearing that they're having trouble accessing capital? And the answer was universally no. So educationally and academically, there's a liquidity shutdown. It's obviously showing up in Turkey and Tim's expertise in some of the emerging economies. It is not showing up here yet. It will. This is going to end badly. Like I don't think Dan and I are on the opposite side of the trade. This market is going to end badly, or the politics are going to end badly? No, this is going to take a hit.
Okay.
So I don't think
Tony, let me ask you a question.
Take a hit. It's what do you do with it?
Tony,
Karen answered the question.
Tony, so when you say it's going to end poorly, so when I look at the United States outperforming the emerging markets, is it going to be where the emerging markets now we flip-flop and now the emerging markets rally, or do the United States catch up to the downside of the emerging markets?
So that's the question. The only way to answer it is, what is the ECB and Bank of Japan going to do? Now, it's no surprise that you've had mixed performance in the emerging economies. We've talked about it on the show, because you don't have every global central bank pumping money into the system. If every central bank is printing money, of course you want to go to the riskiest place with the most growth possible. When 24% of the global GDP, the U.S., is tightening monetary policy, it's a lot more of a mixed picture. So we're very neutral. We did it on the show in the very beginning of the year. We're very neutral on emerging over developed. But here's a news flash. If you look at the Citigroup European Economic Surprise Indices, it's actually trending a little bit higher.
Let's get to Sue Herrera in the newsroom, who has a statement from the aforementioned adult film actress Stormy Daniels. Sue.
Indeed, I do. And this statement is from her and also her attorney, Michael Avenetti. And here it is. This is the statement she gave to NBC News. Quote, Michael and I are vindicated, and we look forward to the apologies from the people who claimed we were wrong, end quote. And for those who don't know, Mr. Cohen's guilty plea today included an admission that he violated campaign finance laws by paying $130,000 to Stephanie Clifford, otherwise known as Stormy Daniels, a month before the election. So, Michelle, back to you.
And he said he did it at the direction of a candidate.
Of a candidate, indeed. And, of course, the president has denied repeatedly knowing about that particular payment.
Thank you. Sue Herrera, who's at the breaking news desk for us, as more of these details come out.
Michelle, I want to clarify something, because Dan's really right, and I'm about data integrity of data. The difference between 1974, you had a 50% decline in 1973 to 74. It was about the shutdown of credit, high inflation, high interest rates. It was 1974 that was a low year, so Dan's correct on that. However, 1998, you didn't have a shutdown of credit,
but I just want to say something. But this is really important. In January of 1973...
Hold on, I want to tell people what we're looking at. I assume this is President Trump. Either is he taking off, or is he landing he's landing in West Virginia? Okay, so he's got a... You talking to me? Go ahead. He's landed in West Virginia. He's going to go on his rally tonight. We'll watch for him to emerge from the plane. Oftentimes, He comes out and talks to reporters who are on the tarmac.
It was like your De Niro imitation there. You talking to me?
He's talking to me. Dan Nathan, finish your thought about 1974.
And I'll tweet this out. Okay, in January 1973, the stock market was at an all-time high. Okay,
Correct.
and then things really started to unfold, right, in 1974. But by the time in October of 1973, when he fired the special counsel, this is President Nixon, the S&P was at 110, so down from 120. It went down over the next 6 weeks. It went down to 90. That's a significant move. So you can talk about inflation, you can talk about whatever. And you know where it bottomed out in 1974, 6 months after his impeachment and his resignation?
But credit was shut down, Dan. You were in a recession.
Okay, but Tony, we were in nothing. In January 1973, the stock market was discounting every piece of bad news that we saw over the next 18 months.
Do you think that President Trump is integral to this market? Because I don't. I think when we elected President Trump, there was a lot of people that felt we needed to deregulate a lot of parts of the market and parts of the global economy.
Isn't this about confidence in institutions? And what is the most important institution that people vote with their wallets all the time?
We're talking about the market. What does the market care the most about? The market cares most about an environment that's business friendly. That won't change if Trump leaves office.
That's
bottom line is, I think.
But he did put those in place, so you're right. So all the things that he enacted
that's not going to change.
Is not going to change.
That was elected by the people. I mean, you have to assume that people got tired of a pendulum that had gone too far in the other direction.
Guys, we can sit here and argue about it. I'm just telling you what happened in 1973 and 1974 from an all-time high. That's all I'm telling you.
But Dan, yes, you're right. So we have to examine, are we in that environment now? Or forget the president. Are we in that environment now? And that case is no, but I understand your point.
But I don't think if that's what existed in January of 1973, they would have had a bunch of dummies like us sitting on there and saying how rosy everything was. And we were going to go.
I wouldn't have been on that show, Dan.
There was you. The 70s sucked. I mean,
but here's my point. My point is that do you think that banks are suddenly going to have a target back on their backs? Do you suddenly think that it's going to be a lot harder for small businesses to get loans? Do you think that the tax rate's going to suddenly go higher?
Don't even go that far. It's just the economic environment right now is not equivalent to the economic environment back then.
Again, driven by inflation, which drove the Fed to intentionally invert the curve and ultimately shut down availability of money. If businesses and households cannot have access to capital, they're going to stop spending and they're going to cut back.
On that point,
opposite
Tony,
of that right now.
You talked about businesses say they got plenty of access to capital, they got a lot of demand. Do they have access to labor? I mean, isn't that the big risk here, inflation? And wouldn't that be driven by labor?
Because we're having over 20% growth in the S&P 500, according to David Aurelio at Thomson Reuters. We're getting over 20% capital spending growth to offset the labor inflation. It's called the productivity trade we've talked about on the desk. You have a rampant productivity because you don't have access to labor.
So you invest in machines, robotics, et cetera, because you don't have people to hire.
Margins, non-financial profit margins in the S&P 500 are at a record high. 2 years ago, everybody was fearing that they were going to collapse. That's with the increased cost. So there's productivity.
Is that